So where should you be looking for value in tech as we move past the peak of earnings season? According to our next guest, nowhere. Downgrading the entire sector to underweight. Is tech now yesterday's trade? Joining us this morning is Truist Co-CIO Keith Lerner, who has gotten, Keith, I would argue, incrementally more negative on tech, and that was before some of these blowups of the past 2 weeks.
Yeah, well, great to be with you, Carl. I mean, first of all, we've been underweight communication services all year long for some of the reasons that were just discussed. And with tech, it's been hit hard a lot this year, but I think it's important for investors to zoom out a bit. Even with this, this year's down or decline, over the last 10 years, tech has outperformed by over 200%. Semiconductors have outperformed by over 400%. And the reason why you buy tech, Carl, as you know, is because of earnings momentum. Well, just over the last few weeks, we saw the earnings momentum for tech relative to the broader market hit a 2-year low, which also what we also saw was prices hit a 2-year low. We don't think that's a coincidence, Carl. So we think that, at best, tech trades alongside the market, but we think there's so much embedded gains that it's more likely to be more of an underperformer as we look out not only the next couple of months, but probably the next several years.
Right. How much vulnerability does that bring to the overall indices if you're just long the S&P? I mean, if these tech valuations really have more correcting to do, where could that lead you on the S&P overall?
Well, I think it tells you that the upside for the market is somewhat capped, right? If you look at tech, communications, and discretionary, those account for about 45% of the overall market. The technology sector, even though it's been hit, it's still trading at a 25% premium relative to the broader market. And what we've seen over the last few weeks, Carl, is the equal-weighted S&P, so a proxy for the average stock, make a 4-year high relative to the S&P, which is really still somewhat top-heavy. And I know we've both been doing this for a long time, Carl. It kind of reminds me about all this spending that went into the market during the stimulus. Reminds me a little bit of what happened during Y2K, where you had all that stimulus and things got ahead of themselves. You talked about all the employment gains that we saw in tech. We just think we're going to go through a period of consolidation across the board.
Well, Keith, what's the turn that you're waiting for in tech then? Because I worry, boy, the real time to stop buying tech would have been December, right? But now things are so much cheaper. Some companies have models that appear to be working a lot better than others. Is it time to just do away with tech entirely, or is it time to get more granular? How will you know when tech or even when some individual names are ready for a turn?
Yeah, it's a great point. And as we mentioned, we've been underweight communications all year long and neutral tech this year. So it's not as if we were, big bulls per se. But, I think a couple of things, John, I would be looking for. I mean, one is just cheaper valuations. And the other thing we really focus on is just the turning earnings momentum. There is a potential that as we go into next year, if we do have a recession, which is our base case, maybe there's going to be some movement back towards tech, some stability there. Maybe, another thing that could help tech is just simply interest rates not moving higher as well. But again, I think the most important thing is you buy tech for their earnings relative to the market, right? You pay a premium because they're able to outperform on earnings relative to the market.